Hello and welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this video, we'll discuss how energy prices are affecting the economy and what it means for investors. The conflict between the United States and Iran has been creating uncertainty in financial markets. Oil prices have been volatile, dropping after an initial ceasefire announcement, then climbing back over $100 per barrel when peace talks recently broke down. While the situation continues to evolve, the most important question for long-term investors is not what oil prices will do next week. It's how the energy costs ripple through the broader economy, affecting inflation, the job market, and corporate earnings. Let's walk through each of these. First, let's talk about inflation. The most direct impact of higher energy prices shows up in what consumers pay every day. The latest inflation report is for March, which is the first month that would have been affected by the conflict in Iran. The report showed that energy costs jumped 12.5% year over year, with gasoline prices rising nearly 19%. That has pushed headline inflation to 3.3%, much higher than the previous month. This has understandably raised concerns about even more inflation. However, there is an important distinction worth making here. Core inflation, which strips out food and energy, rose only 2.6% year over year, coming in well below expectations. What this tells us is that higher energy costs have not yet spread broadly across the economy. Economists often view these types of energy-driven price increases as temporary, particularly if the underlying conflict stabilizes. The fact that oil prices fell after the initial ceasefire announcement supports that view. This does not mean higher costs don't create challenges for consumers or businesses. The main point is that the true effect of these costs will take time to play out, and what investors will watch whether they affect other categories as well. Beyond inflation, the job market is another important indicator to watch. The latest employment report showed 178,000 new jobs added in March, which beat expectations. However, the prior month was revised significantly lower, a reminder that these figures can be noisy. Zooming out, job creation has slowed considerably. Since the start of 2025, the economy has averaged only about 21,000 new jobs per month, compared to 122,000 per month in 2024. Yet the unemployment rate has remained relatively stable at 4.3%. As this chart shows, the stability is partly explained by a declining labor force participation rate, which has fallen to its lowest level since the pandemic. This is largely a demographic story. Over 11,000 baby boomers are reaching retirement age every single day, meaning fewer Americans are actively working or looking for work. When participation declines, the economy needs fewer new jobs each month to maintain low unemployment. For investors, the takeaway is that consumers are facing higher costs at a time when the job market is softening. That said, those who want to work are largely finding jobs, and wage growth of 3.4% is still running ahead of core inflation for many workers. Finally, amid all of this uncertainty, corporate earnings have been a genuine bright spot. Despite the headwinds from energy prices and a slowing job market, consumers have continued to spend, and profit margins have held up well for many companies. Current estimates suggest S&P 500 earnings have grown approximately 16% over the past 12 months, with expectations for an additional 18% over the coming year. To put that in context, the long-term average earnings growth rate is around 7 to 8%, so these are historically strong numbers. Now, earnings estimates can and do change as conditions evolve. Tariff policies, higher energy costs, and a weaker job market could all weigh on profitability ahead. But the current earnings trajectory is one reason that even with recent market volatility, valuations have become more attractive. This is an important point. During periods of geopolitical uncertainty, stock prices often move more than underlying profitability. This disconnect can create opportunities for long-term investors who maintain perspective and stay disciplined. We hope you found these insights helpful. If you would like to discuss how energy prices, inflation, or the current market environment may be affecting your portfolio, please don't hesitate to reach out. We look forward to speaking with you.